Now, as a chartered accountant and someone who's worked in banking for over a decade, when I started my Islamic finance qualification, the concept of Islamic banks was strange. Traditional banks work like this: they take your deposits, lend that money out to other people, charge those borrowers interest, and then give you a small portion of that interest in return. Islamic banks seem to have the same structure, but without interest, instead calling it profit. What really is the difference here? So my criticisms of Islamic banking are many, and while finding any bank that is 100% Islamic is difficult, millions of people use Islamic banks for savings and investments, and they swear that they're halal. To begin, we need to understand why interest, or riba, is haram in Islam. Now, Islam sees money more like water. It should be constantly flowing instead of just sitting there. In conventional banking, money just sits there and somehow it grows. You lend someone $1,000, you do nothing, they do all the work, but you get more than that initial $1,000 back. Money leads to more money, leading to even more money. And that's the core issue here. In Islam, money isn't supposed to breed money in itself. Money is a tool, not a product. So the problem isn't making profit. The problem is guaranteed profit with zero risk. Islamic banks seem to flip the model here. Instead of lending out your deposited money, they trade, partner, or invest and give you a return of those profits. Think of them less like a bank and more like a business partner. And there's three main ways that they go around doing this. So let's say you're a sneakerhead and you want to buy $1,000 of sneakers. Now, in my opinion, that market has crashed, but I'm not going to get in the way of anyone trying to make a hustle here. So at an Islamic bank, it won't give you $1,000. Instead, the bank, what it does is it buys the sneakers up front, then sells them to you for, say, $1,200. You pay that back in installments. Interest? Well, not really. There's no money actually being lent here. Instead, an asset is being purchased, meaning the repayment rate is derived from the asset's value rather than just money itself. The bank also owns the asset, even if it's for a short while, and so there is an ownership risk here. Also, the amount to repay is going to be fixed compared to any variable rate out there. It's like, I'll sell you this thing for more because I'm providing value for doing something that you can't do right now, not because time has actually passed. So this is common in home financing. You and the bank buy a house together. You own 20%, which is pretty much your deposit. The bank owns the remaining 80%. You pay rent for the bank share, and over time, you buy them out. If the house value goes up, you both win. If it goes down, then you both feel the pain together. Likewise, if a boiler breaks down, then you pay the repair cost according to your ownership percentage, and the bank pays the cost amounting to its own ownership percentage. That shared risk is the halal part, unlike a conventional mortgage where only one side will benefit. So here it's all about skills. One side will bring the money, whilst the other side will bring expertise. The end result is that profits are going to be shared according to an agreed ratio, whilst of course losses will equally be shared. There's not going to be any guaranteed returns here, similar to what interest is. Instead, what the bank is doing here is taking a risk with someone for a business venture. All right, so those are three main ways that banks actually give you a profit in return. But is this all actually halal? And here's a real question that everyone is going to be asking. Isn't this interest just with better branding? And honestly, sometimes it can be really, really questionable when you go into the details. Islamic banks are halal in principle because there's no interest, real assets are involved, and there's shared risk. But some banks push the limits. The rate of returns are too close to interest rates, there's too little risk sharing, and they're too focused on profits over ethics. And that's why scholars audit Islamic banks and why not all Islamic banks can be said to be equally halal. Generally, they're all halal by structure, and moving towards halal status is their intention. At the end of the day, there's nothing wrong with the statement of an Islamic bank. A bank is simply a structure, in my opinion, through which monetary transactions occur. And Islamic banks isn't about being anti-money. It's about being anti-unfair money. With the key tenet here being, if we're making money together, we should share the risk and the loss together. No free lunches, no guaranteed wins, just real economic activity. And this is the simplest way an Islamic bank can be explained. But tell me your opinions on the financial structured covered in this video and what your experiences of dealing with Islamic institutions are. As always, I'll see you all in the next video.